Thank you, Madam Chair, for holding this hearing. And Chairman Gensler, as always, it's good to be with you again. Perhaps only a few of our colleagues remember the amount of time when you were CFTC chairman and I was the Ag Committee chairman that we spent in quality hearings. Of course, you'll always note that I focus on things that are important at home. And today I would like to put my particular perspective on the upcoming climate risk disclosure rulemaking that's generated a lot of interest here in Oklahoma, since we are both producers of traditional and renewable energy, and as well an ag area that consumes a great deal of energy. So with that, Mr. Chair, publicly traded companies are at varying stages of climate and ESG disclosure, and the related reporting and climate modeling is still an evolving practice. Chairman, are you concerned that the upcoming climate risk framework could have an outsized burden on small to medium-sized companies? And how might the SEC account for this?
So I'm really looking forward, with the support of my fellow commissioners, to try to put something out to public comment. And a question that you just raised, to include questions like that to the public as to large issuers versus small issuers, as you mentioned. And also, I think implicit in what you're saying is some reporting will be easier to do sooner. I've asked staff to do a look at qualitative disclosure about governance and strategy, but also quantitative disclosure to make sure that the disclosures people are making, particularly around greenhouse gas emissions, have consistency, but how to potentially even phase the implementation amongst large and small issuers, and also amongst the different types of disclosures.
Because many would argue, I think quite correctly, that the small and medium-sized companies are the real generators of opportunity, are the real generators of growth. So we don't want to harm their ability to compete with their big brothers and sisters, so to speak. That said, continuing to think about this issue, you've said your staff is considering quantitative factors such as metrics related to greenhouse gas emissions, climate change, financial impacts, and advancements towards climate-related goals. You've also mentioned many times today about the importance of staff, and we all know that they're critical to whichever branch of the federal government you're in. Could you describe the current depth of climate expertise at the SEC? Are there currently climate and environmental scientists on staff? And is the commission engaged with agencies such as NOAA, the EPA, and the Department of Energy regarding the climate risk rulemaking process?
The answer, the expertise of the SEC is around disclosure about ensuring that the public, looking at the disclosures that are currently, and again, hundreds of companies are making voluntary disclosures now, trying to bring some consistency and comparability to those disclosures. To your second question, yes, we've been in conversations with other important parts of the U.S. government.
It's absolutely important, and as much faith as I have in the MBAs and the attorneys and the poli-sci people, it's important that these other scientific disciplines be involved in this process. Whether it is consulting with the other entities in the federal government that have that expertise or drawing on it from somewhere else, this is too important just to create rules and regs. It has to be done, I think, Mr. Chairman, you and I both would agree, in a very thoughtful fashion. So with that, Chairman Gensler, you've announced that the SEC is considering a review of Treasury market structure. Could you discuss what this review might entail, how you're coordinating it with the Fed and the Treasury Department, and how you might think about the cost and benefits of potential changes?
So we've had a number of challenges in our U.S. Treasury markets dating back to 2014, when there was problems in the pricing in the market. But then in 2019 and 2020, where literally our central bank, the Federal Reserve, was providing liquidity to the market because there were challenges in the financial resiliency. Working closely with our colleagues at the Federal Reserve and Treasury, and also the Commodity Futures Trading Commission has a role here. What we're trying to think through is how we could build greater resiliency into the market. We have $22-23 trillion market. It's at the base of everything else we do in the capital markets. And right now, if I can use a term, we have kind of a multi-nodal system where we have a clearinghouse, we have interdealer brokers, we have big market makers, both principal trading firms and big banks. And if any one of those got into challenges, as we saw last spring and the fall of 2019, our central bank tends to get pulled into providing resiliency. And so we're looking, can we do this better around potentially central clearing? Jay Clayton took up, could we put some rules in place about the trading platforms themselves and the like?
It's